Gold has just hit $5,000 for the first time, but have you missed the boat? And if you already own it, you may be asking, is this the time to sell? We're going to cover all of that in today's video, as well as look at what we can learn from history, what's really driving prices, and what headwinds can we expect in the future. Let's start by looking at some of the factors that have been driving this rally. And to be honest, you could probably sum up this rally as being driven simply by US policy. One of the biggest reasons is geopolitical uncertainty. Gold is very defensive in nature. It's deemed a safe haven asset. So that means at times of unrest and conflict, people will flock to this safe haven asset. And what generally tends to be bad for the world tends to be good for gold. If there's one thing that markets hate, it's uncertainty. And since Trump was re-elected just over a year ago, there's been plenty of that. Tariffs have become this political weapon, and we saw that in April last year on the so-called Liberation Day, where the US announced that they were essentially going to put tariffs on the rest of the world, only to then back out of most of those promises a few weeks later. What was really happening here was anchoring. It was a negotiation tactic. It came in really heavy to then want to make trade deals later on, but by anchoring it to these insane levels, they can then meet somewhat in the middle. And this is how Trump got the nickname Taco President. Trump always chickens out, because he comes up with these outlandish plans that sound extreme, and they are. But then we're not quite sure whether he actually means it, and whether he's going to follow through on it. And he always likes to keep a surprise in his back pocket. He wants to keep the world guessing. And this is horrible for markets. And we've seen this more recently in Venezuela and Greenland. There's this build-up of rhetoric that's so extreme. There's going to be an invasion and we don't care what the rest of the world thinks. And anybody who disagrees with us, we're just going to slap tariffs on them. With Greenland, we saw this build up for a couple of weeks where there was potential talk about invading Greenland to steal natural resources, and under the guise that it was all about defense. And what does that mean for Europe and NATO and the rest of the world? Only for when it came down to it and Trump actually met with the other European leaders, they then agreed a deal. And you wonder whether that was the plan all along. I mean, it probably was. And the problem markets have is every time they come out with a new idea or policy, we're never quite sure whether they're going to follow through on it or how much of it is actually going to be implemented, if at all. And it's this flip-flopping around that is just horrible for markets. And gold has benefited massively from that, being this safe haven asset. Gold is also a non-yielding asset. So that means it doesn't produce an income or a dividend like a company would. That means when interest rates are quite high, gold tends to suffer because of the opportunity cost. Why would you put your money in gold which doesn't produce a yield where you could get 5, 6 or 7% just putting your money into government bonds, for example? So when interest rates start to come down, that tends to be a tailwind for gold because people are getting less yield on their other assets, so they start to look elsewhere. A big conflict within the US in the last year, and this slightly follows on from the previous point about uncertainty, is this independence of the Federal Reserve, the ones who set the interest rates, and this conflict between the chairman, Jerome Powell, and the president, Donald Trump. A central bank and a government should be independent of each other, but what we've seen from the US administration is them putting pressure on the Federal Reserve to cut interest rates. Lower interest rates are generally good for an economy and economic growth because it essentially makes money cheaper. It's cheaper to borrow, but it's also good if you have a lot of debt. And the US has an insane amount of debt. And that's why Trump and the US administration is so desperate to get interest rates down. Interest rates rose following the pandemic to counter high inflation. The US still does have a bit of an inflation problem, and that's not helped by these tariffs because tariffs generally are pro-inflation. So the Federal Reserve have this really tricky balance where they want to reduce interest rates, but they also have to balance the impact on inflation. If they reduce interest rates too quickly, then the inflation is still going to be above their 2% target. And the problem they have is trying to second guess what Trump is going to do. Every week it seems like there's a new tariff announcement or a new spending or policy review, which is partly why they've been slightly more reluctant to cut than other people may want. But what makes this interesting is around May time this year, Jerome Powell is due to leave his position with the Fed, and he could be replaced as someone more Trump-friendly, should we say. And if that leads to looser monetary policy, i.e. they're going to reduce interest rates at a quicker rate, then again, that's going to be another tailwind for gold because people are getting less yield. We've also started to see this move away from the US dollar that was deemed as a safe haven currency not so long ago. But with that general uncertainty and fears around inflation and debt being out of control and not looking like it's going to change anytime soon, the dollar has started to depreciate against other currencies. The US government currently spends way more than they actually earn in tax revenue, and to cover that difference, they need to borrow that money. They generally do that via the bond market, where they would be loaned money from private investors that they would then pay back with a yield, and that's a government bond or a treasury. This works fine up until a point that if you use this system too much, there might not be enough liquidity, there might not be enough willing investors to loan money to the government. And this is where the central bank steps in order to fill those gaps in liquidity. They start buying government debt. And in order for the central bank to do that, they essentially print money, or what's known as quantitative easing. And up until last month, they were actually quantitative tightening, meaning they were reducing the assets on their balance sheet. But they've now announced that they might have slightly more looser monetary policy, and they might start quantitative easing again adding to this depreciation of the dollar. All this is to say that when people start to worry about fiat currencies, they'll start looking at other assets that can't have their supply manipulated. Hence, gold also starts to rally. And the reasons we've discussed so far have also led to central banks buying more gold themselves. They buy this when times are uncertain and they're worried about inflation and general devaluation of the dollar, because that's what they would hold as their reserve currency. And central banks tend to buy on a regular basis. So they would set out a plan to buy over the next few months or few years. And it doesn't matter what the price is, they just want to accumulate. So they're not trying to time the market or beat it. So you tend to get this steady flow of demand that's continuously buying gold. Again, just another fuel to the fire. And we also have to talk about the flow of capital and the potential sell America trade. And when you see assets like gold and other precious metals go on rallies like they have done in the past couple of years, that also drives investors to that market. It drives momentum. And people are looking where else to put their money. We've seen AI stocks boom over the last few years. But now people are starting to feel like those valuations are quite frothy. They're starting to feel like they're overvalued. And they're looking where else to place their money. If you're holding on to tech stocks, or really any American stock, not only are you worried about a potential equity crash, but you're also investing into a company that's denominated in a devaluing currency relative to other currencies. We have started to see a shift towards other equity markets around the world, but this has also caused an influx into the gold market. And this is what's made this rally so unique. It's not just one of these factors, it's all of them coming together at the same time. And that's what's made this so explosive. So that's some of the main reasons for this rally. But the question that people really want to know is this going to continue? And this is where I think context is so important. Gold tends to be quite cyclical. It will go on these massive rallies and then it will eventually top out and then it won't do anything for a long period of time. And people will start to accumulate again until the next phase. There's a saying in the trading world, if you're in doubt, zoom out. I want to show you what happened in the last phase. And this is not to say this is exactly going to happen again, but hopefully this helps manage somewhat of your expectations. So this is just after the global financial crisis. And in a similar way, in that period, we saw interest rates cut dramatically because central banks were trying to stimulate their economies. And we saw gold go on this run from about the end of 2008 all the way up until September 2011, where it did about 170%. A massive, massive rally. And actually, this wasn't even the start of the rally because this was just a dip. It had actually started way back in the early 2000s. It's crazy to think back at this time in 2005, 20 years ago, gold was a tenth of the price that it is now. So we had this massive rally that topped out about September 2011, just under $2,000. But then what happened after that was a long period of not really a lot. Actually, when you compare this top here down to where it bottomed out about here, so this is December 2015, was actually negative 45%. From there, it then took until about July 2020 for then gold to hit its previous all-time high. And then even when it did break into a new all-time high, it didn't continue. It then chopped around for a bit until it eventually broke out around March 2024. So if you are worried about missing out on the gold rally and you're not able to invest right now, just know that there are periods where it doesn't do anything for a long period of time. From 2011 to 2020, 9 years, and that's before inflation, holding an asset that hasn't done anything. And remember, this is a non-yielding asset. If you own a stock and the share price stays exactly the same, you could still be receiving dividends. If it's paying a 3% dividend, for example, at least you're getting that 3% per year, even with no capital growth. With gold, for you to make money, it relies on other people buying it at a higher price. At the same time, you've also got to ride out volatility. Like I said, that came down 45%. If you've got a long time horizon, hopefully, and maybe you can ride that out, but you've got to make sure you're comfortable with that. And that's why when people say gold is a safe haven, you mustn't confuse that with being a safe asset. Like when we get close to retirement and people start moving more into fixed income like bonds, as opposed to holding equity. If you think that gold is safe because you've heard the term safe haven, that doesn't necessarily mean it's a safe asset because it's so volatile and it can be very news driven. So now we're sitting at new all-time highs and it feels like we're constantly breaking out almost on a daily basis. So what do you do now? I suppose the first thing to ask yourself is, what is your reason for investing? Ignore the price for a minute because it's so easy to get carried away with seeing this steep rise and then start to try and play technical analysis. This is so much more fundamentally driven. Go through the tailwinds that we discussed: the uncertainty, the devaluation of the dollar, the Federal Reserve cutting interest rates, and people generally might be moving away from American assets. You have to ask yourself, if that's the tailwinds that have driven this rally, when are they going to stop? And if you can't see that stopping anytime soon, then there's no reason to suggest that we've hit a top of gold. Because for gold to hit a top in it for it to reverse, some of those tailwinds have to change. At some point, these fears will start to ease. There's midterms later this year. We don't really know exactly how that's going to affect things, but there is an election 2.5 years away. Interest rates will likely continue to come down this year, but then they could bottom out. So there's no more rate cuts to be priced in. Inflation hopefully will continue on its way down. And again, that should settle. So if you've got a long enough time horizon and you can ride out volatility, you're not going to be emotionally scarred if it drops 10% in a week. If you can do that, then you almost need to forget what the price is and almost ignore what it's done previously. All your decision really is that opportunity cost. Is there a better potential and opportunity elsewhere? And if you don't feel there is, if it's in the equity markets, then potentially you start to move into gold. And it never feels nice investing into something that's gone on such a big rally because you feel like you've missed out. But it's also like buying something that feels more expensive than it needs to be. We all love a discount when we go to the shops. And with something like this, you can be waiting for that discount for a long period of time. So let's take it back to the middle of last year, just after that Liberation Day tariff announcement. Let's say you're sitting around this period, but because you've seen gold go on this massive rally, you've said you don't want to invest because there's almost too much uncertainty. You don't know which direction it's going to go. And if anything, you want to wait for a dip. So instead of buying here, you wait for it to dip. The problem is that then gold goes up in value a lot. It then did dip in around October last year, and I think it was just over 10%. Yeah, about 11%. So even if you caught the bottom of that dip, and bearing in mind, you either got to set it at exactly 10% or you're going to do it manually, and you may even miss that bottom. Say you were able to miraculously capture that absolute bottom, you're still way higher than if you would have just invested earlier on. And the same thing could happen just now. Again, I'm not saying this is going to happen, but say gold managed to get closer to 6,000, even if it then dipped 10%, we're still above where we are now. Even if it dips 15%, that brings us back closer to around where we are now. And if you think 6,000 is so far away, that rally back in 2008 to 2011 was about 180%. And again, we're not saying that history is exactly going to repeat. But if we just took this point where it actually started to break out, which was around, it was around March 2024, 180% takes us to 6,475. This would take us then to the early part of 2027. I do want to keep stressing this is hypothetical, but sometimes just planning it out like this can give you an idea of what it may look like. What we're saying is it's not going to move in a straight line to that point. You've got to be able to ride this out because along the way, it might hit 6, it may even get to 7,000, but we may have a 15, 20, even 25% dips along the way. So if you decide that you do want to buy, you've essentially got two decisions. You either invest by a lump sum or you invest regularly. And that might depend on your individual circumstances, whether you've actually got that lump sum to invest. It could be that you're switching from another investment. Or if you're just investing regularly, then I don't think that's really a decision because even if it then does dip and you've got the long time horizon, you're investing regularly anyway. So you're still going to capture lower prices. You're not necessarily concerned about what the price is in next year or the year after. You're more concerned about what it does in 5 or 10 years' time. So if you're investing regularly, I don't think it's too much of a decision, or there's less risk, should we say. If you're investing in a lump sum and you're really nervous about investing so high, what you could do, on paper, it might make sense to say, oh, well, history shows us that the stock market and assets like this tend to go up more than they go down. So that would say, get your money in as early as possible. But sometimes what's best on paper isn't always what's best for you. And if you're able to sleep better at night, knowing that you're averaging in, then potentially that's just a better situation for you. So you might invest into something else and then drip feed into gold. might be every month. It could be more regular. You could do it every week. And then that means that you've got some money in the game, so you don't feel like you're missing out. So if it does go up in value, at least you've got some skin in the game. But if it then starts to dip, you know you haven't put your whole bag in there, and you're actually going to be able to capture those lower prices. You could use exactly the same strategy for selling as well. I think a lot of people, when they think about selling, is that they have to pick one point. But just the same way that we can average into an investment, we can average out. And your reason for selling, again, is going to be unique to you. What are you going to do with that money? Have you got another opportunity to put that money elsewhere? Again, going back to those tailwinds, do you start to feel that some of these are going to change? You could say you're going to sell 10% every month for the next 6 months, and then you're going to see what it's looking like at that time. Remember, things can change very quickly. A lot of this is based on that uncertainty, but things can become a lot more clear very quickly. And we've got to be careful that we don't read into things too much. We've seen that so much with the Russia-Ukraine war, where we've seen these meetings where we feel like we're one step closer to peace, or at least a ceasefire. And the markets will start to react to that because we feel like we're somewhat closer to ending the conflict. But then what turns out, it's not the case, and we're just going to delay the process even further. I'm not going to get into that. But what you've got to think about is these conflicts can be resolved not very quickly, but the rhetoric around the conflict can change very quickly. And if the markets feel like peace is on the horizon, then that changes the picture in the game almost completely. And you could also say the same about interest rates. There's only so much they can be cut. At some point they will hit a floor, and the central bank, regardless of how independent they are, won't be able to reduce it any further because it just wouldn't be economically viable. And then at that point, although gold might have continued its rally, that's already been priced in, and then it hasn't got that tailwind moving forward. And that's how these rallies start to peter out. They've got all these tailwinds right now, and that's why the rally has been so massive. But then over time, say over the next 2 to 3 years, could be the rest of the Trump presidency. That could be all of these tailwinds coming together and not suddenly ending, but over that time, they'll start to end. That uncertainty might become a little bit more clearer. The dollar might have hit a little bit of a bottom. Rate cuts might have hit that floor. Depending on what happens with an election, there might start to be more confidence in the US. And all of a sudden, we've seen this asset that's massively risen in value. People are sitting on a lot of profits. That's when you get these blow-off tops, and eventually that rally comes to an end. But until that happens, this is definitely going to be an exciting one to watch, albeit a very volatile one. Let me know your thoughts in the comments. Hope you found it useful. Thanks for watching.